Hello and welcome. This is the Market Wrap. Pardon me. This is the stocks to watch on BloombergQuint. I am Agam Vakil. This is where we take you through a handful of stocks and sectors and talk about them with our experts. So stocks which are in focus on the back of news, perhaps some interesting developments coming through. And today we are going to talk about Nestle India, IndusInd Bank, as well as Info Edge. And to take us through these stocks, we have with us Rusmik Oza. He's the head of fundamental research at Kotak Securities. But before I get Rusmik into the conversation, let's address the first stock that's in focus, and that's Nestle. Now, it's reported a net sales growth of around 1.7% for the quarter gone by. That is the second quarter of calendar year 20. And not only have the earnings been muted, but they're also slightly below consensus expectations. We've seen net profit rise 11%. Sure, there's been a growth. And we have also seen an expansion in your EBITDA margins coming in at around 24.5%, a little bit of an expansion coming through. But on the whole, the headline numbers are not as robust as what we may have liked or expected, especially considering one of its peers, Britannia, which is also in foods, FMCG, has done much better. Let's get Rusmik in. Rusmik, good morning and thanks for joining in. What's the way forward for Nestle? How are you reading into this?
Good morning, Agam. Nestle, the result print has been a little weak as compared to all the other peers. Mainly the reason cited by the management has been some logistic issues, supply chain issues, and a decline in the non-essential product portfolio, that's chocolates and beverages. I think unlike the other peers, they've been little on the back foot, I think, so in terms of managing the supply chain. But going forward, we expect things to normalize, especially the essential parts, that's dairy, noodles, and some of the other, milkmaid, dairy products. I think that should do well going forward. For the whole year, we are still expecting a revenue growth of around 11% and then escalate further in next year. Good thing for Nestle is they've maintained the EBITDA margins at around 24.5% range, which is a good thing for the company. And I think it's only a matter of one quarter. Things will improve going forward. Only issue with Nestle, we have a reduced rating on the stock is because of the expensive valuation. The stock, trades at some 75 times on the 1 year forward multiple and some 63 times on 2 year forward multiples. So valuation is something which keeps us, on the back foot as far as Nestle is concerned. It's a good franchise, a good company. So as and when you see a decent correction in the stock price, one can look at buying the stock at lower levels.
Okay. All right. So that's your view on Nestle, and there's no contention about the fact that it is one of the most expensive FMCG companies out there. But from there on, we move on to IndusInd Bank. And this is where we've seen, once again, earnings, we're steady in terms of consensus. It's a wait and watch, but net interest income has grown around 16.5%. Profitability, however, has taken a knock. It's down 68%, but that is also on account of higher provisioning that we've seen in the quarter. We have seen a little bit of deterioration when it comes to GNPAs. NNPAs, relatively steady. Perhaps a positive also is that the moratorium numbers have come down dramatically from 50% in April to as much as just 16% now. But these earnings are certainly very mixed at this point in time. Rusmik, what's your view on IndusInd Bank?
We have a positive view on IndusInd Bank because there's been a big derating in the stocks price in terms of valuation. The stock trades at less than one time price to book on FY22 estimate and also an FY21 estimate. I think maybe the company needs to, going forward, deliver a couple of quarters of decent numbers, and consistency should come back for it to again, look at some kind of re-rating. Few things to watch out for is obviously, as compared to other peers, we'll have to watch out how much fundraising the company does to strengthen the balance sheet. The last quarter numbers were quite in line with expectation, and no major surprises as such. I think the gross NPAs have been steady, but a provision coverage ratio has gone up to almost 67% as compared to 43% last year, like to like, which is reduce the net interest margin to around 0.9%, which is good. So on the qualitative aspect, I think it's better off on a quarter-on-quarter basis. Things are looking a little better. somehow the earnings degrowth of 68% is something to watch out for. As you said, the moratorium is a tricky thing. I think for all of the banks, most of the different banks are reporting moratorium in different fashion. The real picture of moratorium will only come in Q3, that's December quarter. So as of now, I think so. As compared to the peers, valuation-wise, IndusInd Bank looks quite attractive. We have a positive view on the stock. Hopefully, one needs to see the consistency in terms of performance for the next 2-3 quarters, and then we can expect some kind of re-rating happening in the stock.
We move on to the final stock that's on our radar, and that's InfoEdge. Now, the news that we have on hand is not significant for the company. Well, the company's stake in Ustraa has fallen from 42% to 30%, and of course, that particular investment has raised about 50 crores from IFL Private Equity, and that's the reason why InfoEdge's stake in that company has come off. But this is not going to be something that's going to be moving the needle for the stock. The reason why I picked up InfoEdge is because it's seen a very interesting move of late. It's trading well about 3,200 rupees a share. The real question is, after the management has suggested that a lot of the prospects of the company depend on the economy, where do we stand in terms of InfoEdge? So Rasmik, I take this one up with you. Your outlook, your overall play on InfoEdge, where are you seeing things here?
Yeah, Agam, InfoEdge is actually has a lot of moving parts. Too many businesses hosted in one company. The recent acquisition, they've done some acquisition also, and some they keep on doing this because in early this year they had set up a VC fund, and they've almost invested in more than 50 companies since then. So this is their core activity of investing in startups, which is continuing to progress. We'll see this informations about investments and divestments on a regular basis from the company side. Coming to the core business, I think so. The two main businesses which are the main driver of the company, which is Naukri.com and 99 Acres. Somewhere Naukri.com has seen improvement in billings after the sharp fall in April and May. So somewhere we expect the business and the billing of Naukri.com to improve in the first half and then further go up in the second half. That's not the case in 99 Acres. I think 99 Acres, we know that the real estate business is still struggling. So it will take a little longer time for Naukri.com to normalize its business operation. The other businesses, I think Zomato impact is there because of this, lockdown and social distancing. I think Zomato probably could be a little impacted. The other two businesses like Jeevansathi.com and one more business, they are not doing anything great as such. So if I'm looking at sum of parts valuation, I think our numbers are quite conservative. We have a price target which is way below the current market price, and we have a sell recommendation in stock. Reason is that we like the entire franchisee and the business model of upcoming segments and everything. But we need to wait and see how things go forward. So recently there are 2-3 things which are coming from the company side. They have enabling resolution to raise around 1,875 crores to QIP. I think that's one thing to watch out for, and the deployment of that funds going forward. And two is maybe how the main 2-3 segments of their business do. So even though we are valuing, say Zomato at the last previous funding, that's around $3.5 billion, and Policy.com at $1.5 billion. Apart from that, we value the standalone business at around 35 times. So our price target is way below. It's around 2,100 or so that way. So we have a sell recommendation mainly because of the lofty valuations the company trades. So if you want to compare this company with startups or probably upcoming businesses, so it's already trading at 32 times EV to sales, which seems to be quite on the higher side for the company. So that's about InfoEdge.
Okay. All right. Fair enough. Rusmik Oza, we leave it at that. Thank you so much for joining us and taking
Yeah.
us through your views on these companies which are in focus. And on that note, it's a wrap on this segment. But there's lots more lined up. Stay tuned to Bloomberg.